Hi everyone, happy Friday Money Wind Up. So, I think we need to talk about what's topical today. Interest rates went up on Tuesday. So, what does this mean for you? 0.25% interest rate hike. We could see it coming, but we didn't want to. So, this week, the RBA has delivered a 25 basis point increase to the official cash rate. Lifts it from 3.65% to 3.85%. This makes the first rate rise in more than 2 years, reversing the easing cycle that we saw through 2025 as inflation started to creep up. The RBA's stated aim is simple: cool, stubborn inflation that has stayed above its 2 to 3% target range for longer than expected. But for the millions of Australians out there carrying a mortgage, this decision is not academic. It translates into real dollars. So how does this hit the average home loan? When the RBA lifts the cash rate, banks typically pass that increase on to borrowers. In this case, the big four, CommBank, NAB, ANZ and Westpac, have already announced they'll add 0.25% to their standard variable rates in the coming weeks. A lot of the smaller lenders, the second-tier lenders, they've done it as well. Not all have yet, but guarantee they will. Here's the blunt reality. For a $600,000 home loan, you're looking at roughly $80 to $95 per month more in repayments once the rate pass on kicks in. Now, it won't necessarily kick in straight away. It can take a couple of weeks. That's nearly $1,000 a year out of household budgets, just from one rate hike. Some news outlets used rounded examples for, public figures, like, Treasurer Jim Chalmers' mortgage, but that day-to-day impact mirrors what many ordinary borrowers are about to feel: more cash going out the door each month. And a 0.25% increase isn't just about monthly repayments. It also affects your borrowing capacity. You could borrow up to 4% less than before, meaning your house buying power shrinks. Budget stress, repayments eat deeper into disposable income, squeezing households already battling higher living costs. And the market psychology. So rates rising can subtly cool property demand. Some buyers pause, waiting for stability. So you might ask why the lenders passed the hike on, and fast. Here's the no-nonsense mechanics behind it. RBA's cash rate is what banks pay to borrow money themselves. When that cost goes up, lenders don't eat the difference. They stack it onto home loans so that their profit margins aren't crushed. Most variable rate borrowers feel the change within weeks of an RBA decision. So, if you're on a standard variable rate with one of the big banks, you won't have to wait long to see your new rate reflected in your next statement. What does this mean for different borrowers? So for variable rate borrowers, you're first in line for the impact. As soon as the banks update rates, your repayment goes up. Not huge in percentage terms, but still noticeable in your budget planning. For new buyers or borrowers with a high loan-to-value ratio, higher repayments mean less wiggle room, and that can knock your borrowing capacity when applying for a loan or refinancing. People coming off fixed rates. If the fixed rate has just ended and you roll onto the new variable, you'll feel the full impact, especially if your previous fixed rate was lower than the market average. There are some people still coming off the 2% fixed rate that happened, 5 years ago. Savers. There is a silver lining. Interest on savings and term deposits tend to rise alongside loans. But it's not much consolation if your biggest cost, your mortgage, is simultaneously bleeding you dry. So the final take on this: Australia's housing market has been floating on historically low rates for a long time. This 0.25 point hike is not massive in isolation, but it signifies a shift in monetary policy. If you're a mortgage holder or a buyer, here's the truth: this isn't the last hike we might see. Markets are pricing in more increases this year. budget for higher repayments now. If it's no longer if rates rise again, it's when. Reach out to your broker or your lender early if you're feeling squeezed, not after you're struggling to make repayments. Upward pressure is back. Your mortgage isn't just a number on the screen, it's something that's going to hurt your wallet unless you plan for it, and that's the bottom line. If you are struggling with these, have a look around. Ask your broker about fixed rates and whether maybe fixing it for a little while, 2 years or 3 years, might actually help you along your way or keep you solvent. Sorry to be the bearer of bad news on a Friday afternoon, but another good reason to have a glass of wine. Happy Friday Money Wind Up.